Competition and Markets Authority has launched an inquiry into price-fixing collusion among major house builders. But that won't solve land supply problems nor build more public sector homes, the twin devils of the housing market. Are there reasons to hope change is on its way? I'm David Tame, Analysis Editor at Place North. In today's Place podcast, we'll take a look at the broken housing market and what might fix it. We'll also be taking a glance at the latest gloomy financial numbers from the leading property consultancies and wondering if the bad debt mountain may have peaked. The immediate outcome of the Competition and Markets Authority report, published on Monday, was the decision to look more closely into 10 major house builders on the suspicion that they'd been colluding anti-competitively to keep delivery of housing down and thus prices up in various localities. But it also produced a 374-page reasoned analysis of the market, which is well worth your time. If you get as far as page 169, you'll find a table which shows how close local councils got to meeting their assessed need for housing over the 3 years 2019 to 2021. The answers are fairly encouraging for the North. The North is doing okay. In Yorkshire, just one local council out of 21 failed to hit 75% of its target. In the North East, the figure was one council out of 12, and in the North West, 3 out of 38. In 2021, the proportion of councils hitting 95% of their target, that's getting within a whisker of success, was 10 out of 12, 17 out of 21, and 30 out of 38 respectively in the 3 regions. That represented, for what it's worth, a real advance in Yorkshire and the North West, where several laggardly councils pulled up their socks. But the real story is about land and the constraints upon it. The Competition and Markets Authority notes that it's relatively floody in Yorkshire. About 13% of all land is subject to flood risk, among the most floodable regions in England. Moreover, the north is disproportionately hilly and beautiful, meaning much less land is available for development. 2/3 of northwest councils are hobbled by having too much beauty around them, meaning they have less than 30% of their land available for development. West Lancashire, South Ribble, Chorley, Warrington, York, Doncaster, Wakefield, they're all in this category. But the North is good at developing brownfield land. Approaching 70% of new housing development in the Northwest is on brownfield land, more than 60% in Yorkshire. It drops to about 40% in the Northeast, one of the worst regions in the UK for building on brownfield. The problem is that some parts of the North need to get considerably better at building on brownfield. Ironically, it's the most densely populated urban areas which need to improve the most, hence the government's recently announced brownfield presumption. This would ease the path to permission for brownfield development if the locality had not met that 95% target of its housing allocation. The cities included in the list, the cities in the top 20, are Bradford, Leeds, Liverpool, Manchester, Newcastle and Sheffield. Consultation will run until the 25th of March. But 3 data releases from Savills make a very nice counterpoint. The first turns on the fact that the 20 largest cities account for 90% of the shortfall in housing need. On the face of it, not a surprise, because big cities have large, fairly needy populations. The top 20 aren't actually doing badly, granting consent to about 28% more homes than they strictly need, and as a result, getting housing delivery within a whisker of its target, just 3% below what's required. The trouble is that they'd need to approve even more, about 35% above target, to fill the gap. And they're also going to need help from neighbouring areas to help make up the numbers. Unfortunately, the neighbours aren't being very helpful. The councils next door to the top 20 are missing their own targets by a wider margin than the cities, by about 8%, says Savills. Bury and Stockport in Greater Manchester and most of West Yorkshire outside Leeds are on the naughty step. They can't entirely be blamed because over a third of their land is greenbelt, so out of bounds. And of course that's the government's problem. Whoever one wishes to blame, the net result is that the combined gap, the big cities own and their neighbours, begins to yawn. Land prices might have a role to play here. Both brownfield and greenfield land prices are falling, but brownfield land prices are falling faster. Savills say UK greenfield and urban land values fell by 0.8% and 1.3% respectively in the final quarter of 2023, taking total annual falls to 6.5% for greenfield land and 8.4% for urban land. And yes, the house building scene is quieter, which helps explain it, but also, yes, the cost of money is higher. So inevitably that means developers aren't bidding up prices with the abandon of recent years. The old wisdom is that land accounts for about 1/3 the gross development value of housing, so this slide in values could make a difference. But have the seeds of a solution already been laid? The final piece of Savills analysis suggests it might. Whilst home building fell in 2023, down 9% on the 2022 figures, there are signs of growth in two of the places you might hope to find it. The delivery of affordable housing is up sharply to reach a high point not seen since 2015. The volume of socially rented homes is up particularly sharply, 26%, albeit from a small base. And at the same time, build-to-rent completions rose by 57%, taking the UK's total stock ticking past 100,000 units. Build-to-rent starts weren't quite so healthy, but the pipeline is well stocked, and so it might not make much difference. Those social housing figures matter. If the housing sector is in crisis, this isn't a crisis made by the private sector, as the Competition and Markets Authority itself concludes. They say it's worth noting that these recent levels of house building are not out of line with what the market has produced over time. The only years in which house building in England and Wales approached or exceeded 300,000 homes a year were during periods with significant levels of local authority house building, end quote. In other words, if policymakers think the market needs more or different housing, they need to build it themselves. And now your weekly rundown of what is going up and what is heading the other way in the Place North elevator. Doors closing, going down. Property consultancies are feeling the February chill, according to the latest data drops. JLL reported this week that its global income plunged by 64% in 2023, despite a modest uptick in the final quarter. Slow leasing activity cut fee income. It was reported early last year that there would be 300 UK redundancies among its roughly 3,000 UK workforce. So testing times. Worth noting that JLL never confirmed the numbers, and still won't. Knight Frank was also said to be mulling a significant number of job cuts. Reports in October 2023 suggested 3% of its UK workforce would go, meaning perhaps 90 or 100 jobs. Subplot asked for an update, but Knight Frank declined to comment. Could there be more to come? Avison Young insists it's not in trouble after Standard & Poor, the credit reference agency, said on Monday that the Toronto-based group failed to make required quarterly principal and interest payments on its senior secured term loan. This is said to refer to about £375 million worth of debt accumulated in 2019 and 2022. The latest unhappy news comes after Avison Young's November 2023 decision to offer voluntary redundancy to UK staff. Time will tell whether voluntary redundancy turns into something tougher. Meanwhile, CBRE is also looking for cost savings. Property is always the first down and the first back up again when the economy wobbles. Folks, this is what a recession looks like. The good news is that the volume of commercial property loans defaulting is about what everyone expected. The bad news is that's still enormous. AEW, the real estate investment and asset managers, slipped out some numbers on Wednesday, which will provide some limited comfort. AEW's research estimates that 7.5% of the commercial property loans agreed in the UK and European mainland 2018 to 2021 have defaulted. That's about £36 billion worth of loans, amounting to about £12 billion of losses for lenders. This is about the same level of distress as the years immediately after the 2008 global financial crisis. Now, lenders are offering about £77 billion less debt than borrowers need to refinance their existing loans, says AEW. That in turn means that about 16% of UK and mainland European commercial real estate loans could be up the creek without a paddle. And please also bear in mind that about a fifth of loans now have 100% loan-to-value ratio. In other words, there is no borrower capital left, no wiggle room, perhaps no hope. But don't despair. UK real estate borrowing costs are forecast to reduce to 5% by the end of 2025. Given the positive spread between prime yields and debt costs, AEW expects lenders to be expanding their loan books in the UK by the end of this year. This is sooner than previously expected, they say, and should allow investors to become more active. Fingers crossed, they're right. So that's it for this week. We've seen how getting tough with house builders won't necessarily solve the land supply problem, taken a look at the commercial property industry's stock of potentially bad debts, and asked when the next round of property consultancy redundancies can be expected. For more about the built environment in the North, visit placenorth.co.uk. I'm David Tame, and thank you for listening.